Since 1984, independent investment research firm Dalbar has published its annual Quantitative Analysis of Investor Behavior report, or QAIB. It's one of our favorites at IFA, and we have here with us today Cory Clark, and he's going to explain a little bit about the methodology and kind of the brunt overall findings of the reports. And each year, Cory, they seem to say the same thing. Investors are likely to be their own worst enemy.
Mm-hmm. Yeah. So maybe to level set a little bit, it might be helpful to talk about how Quabe sort of came to be. So we published our first report back in 1994, but a few years prior to that, investment companies had come to us because they had, I guess, what you could call an investor communication problem or an investor services problem, in that they were directly getting questions, their distribution force was getting questions from investors that would get their statement and see the stated return of their investment and see their personal rate of return and concerned about the discrepancy between the two. And so they came to Dalbar to look a little bit more into this discrepancy and develop a communication strategy. And what we found is that it wasn't an isolated incident. It's not an investor here or an investor there. This was pervasive throughout all types of investors, all types of funds.
And the communications issue was investors didn't seem to understand that what they were actually getting from their portfolios and what the indexes were returning was quite different.
Right. And I think the industry knew that it was, the reason for that was cash flows. I mean, particularly if you're comparing it to a prospectus return that's net of fees. So, now you're really isolating those discrepancies in terms of cash flow almost exclusively. And as an industry, we knew that, but we wanted to dig a little deeper into it. And that ended up becoming Quabe.
Yeah. And Cory, by cash flows, you mean how much and when they're actually putting money into their portfolios.
Yeah. So what we do, and this is a good segue right into the methodology, is what we take the aggregated cash flows from the investment companies of all mutual funds registered in the United States. We break it out by equity funds, fixed income funds, or asset allocation funds, which are your balanced funds, target date funds that hold a mix of fixed income and equity securities. And so what we were able to do is we're able to get the aggregated data of what the net assets were at the beginning of a month, all the money that came in, all the money that came out, all the fees, withholdings, and final assets. And what we're able to do is isolate the money that's earned and make that comparison. So that aggregated data we consider a proxy for the average investor.
Okay. And so you compare how much they net and how much the indexes net.
Right, exactly. So for each year, and we do it on an annualized basis too, we do look at 30 years, 20 years, 10, 5, 3, and 1. And it's the same thing. And from any time frame, the average investor earns less, in some cases much less, than what the individual investment return might suggest or what indices might suggest.
And why is that then? What is the conclusion here?
Mostly behavioral, or at least in terms, if we want to isolate a cause that us as an industry can maybe affect, then it's the behavior. We've identified 4 major causes. One is obviously fees. If you're comparing to an index that has no fees, so maybe 70, 80 basis points, something like that, might be attributable to fees on an average or aggregate basis. But then there's also the availability of cash, the need for cash, and then behavior. So we don't necessarily think that if one had to stop making contributions because there was a shortfall and they didn't have the availability to invest, that's not necessarily behavior. And on the flip side, if one needed to take a withdrawal to cover a medical bill or something like that, that's not necessarily behavior either. So we do acknowledge that there's some proportion of that going on as well. But in terms of what we can control, and a large portion of that gap, it's behavior, and so that's really what we're trying to tackle on an annual basis through this study.
And by behavior, how do you measure that?
Well, a few ways. One way is through retention rates. And so this is really looking at the velocity of money movement. And we see that these retention rates decline during when the market declines, and they grow when the market is advancing. So that's one way that we measure behavior. We can also measure it just by looking at the money in and out of the equity or fixed income portfolio in general. We can see that the average investor might be moving out of equities and into fixed income. And then we also look at how those cash flows coincide with what the market did subsequent, which we call the guess right ratio. And what we find is that investors actually guess right about half or more of the time. Problem is that when they guess wrong, the dollar amount proportionally is enough to outweigh 3-4 months worth of correct guessing. So there's a lot of different ways that we try to get at behavior and measure it, and we see the same general trends depending on how the market is trending that particular year.
So if you want to try to outguess the market, you're basically going to have to guess right on both trading in and also trading out.
Yeah. You might have to guess right every time, because one wrong guess could wipe out all the other correct guesses. So yeah, I mean, what we advocate, and I think one of the main themes of the study, is not to try to time the market. I think we don't do this piece, but I know it's a very popular piece of, if you miss the 10 best days in the market, things of that nature, nobody's going to be able to predict those, call the bottom. So don't try.
Yeah. And also it's interesting, over any short or longer time period, over these 30 years that you've been doing it, the results are pretty much the same, right? It just, market timing just doesn't work.
Yeah. And typically when we look at longer time frames, it becomes worse because that gap is compounding, so I mean, then there are times where there's one particular year might have a large acute underperformance, but generally speaking, the longer the time frame that we look at, the greater the gap.
Okay. Well, thank you for your time today, Cory.
It was my pleasure.